Welcome to the deep dive.
Great to be here.
Today, we're really getting into something vital for anyone trading successfully, consistently anyway. We're talking about the mental skills.
Yeah, the psychology of it all.
Exactly. We're digging into insights from a YouTube video with Mark Douglas,
Mhm.
really trying to grasp that psychological foundation, you know?
And how changing your thinking can actually change your results. It's huge.
It really is. So the mission for you listening is to get a clearer picture of this psychological side, maybe pinpoint shifts you can make.
And the source material kicks off with some pretty revealing questions about
Oh,
attitudes.
yeah, those questions, they really hold up a mirror, don't they?
They absolutely do. It shows up the common beliefs, maybe misconceptions that can really hurt traders.
Okay, let's dive into them. First one, is making money as a trader primarily a function of analysis? What did the original folks think?
Well, interestingly, not many thought analysis was the main thing.
Right. And the key takeaway seems to be analysis is important, sure, but it's not the whole story. It's really about execution.
That's it. Execution. It's such a crucial distinction. You can be a brilliant analyst, but if you can't act on it,
Then it doesn't matter much for your bottom line, does it?
not at all. You have to be able to, pull the trigger, manage the risk, follow the plan. Trading is execution, fundamentally.
It's not just knowing, it's doing
Yeah.
consistently. Okay, next one. Do you often think there must be a way to trade without taking a loss?
Ah, the dream scenario.
Right. I mean, be honest. Have you listening ever thought that? The original responses suggested, yeah, many have.
It's totally understandable. Nobody likes losses. But it shows a bit of a misunderstanding, doesn't it, about what trading actually is.
How so?
Well, losses aren't like mistakes necessarily. They're a cost, part of the process, like a business expense.
We're like strikeouts in baseball.
Yeah,
Even the
but-
best.
Exactly. Great analogy. Even the best batters fail way more than they succeed on any single at-bat. Losses are just the flip side of wins when you have an edge over time.
Okay, that makes sense. And sticking with challenges, do you have trouble getting out of a losing trade?
Oh, this one hits home for many. The video showed a lot of agreement there.
Yeah, that feeling of just hoping it'll turn around, clinging on.
It's a classic emotional trap. You don't want to admit you were wrong, or you hope the market proves you right eventually. But that hope, it can be really expensive.
Leading to much bigger losses than you planned for.
Precisely.
Okay, what about this one? Do you find yourself planning trades you never execute?
And executing trades you never planned.
Yep.
The knowing-doing gap strikes again.
That disconnect. You know what you should do, but then the market's moving. Emotions kick in.
And you do something else entirely. It often comes down to not fully trusting your strategy, or maybe fear or greed taking over in the moment.
Overriding the plan. Okay, this next one requires some real honesty. If you thoroughly analyzed your trading results, would you find that your average losing trade is much bigger than your average winning trade?
Oof, yeah, a tough one to face. Some in the original context thought this might be true for them. Have you ever actually crunched the numbers on your own trades?
It's revealing, isn't it?
Definitely. If your losers are consistently bigger than your winners, that's a huge red flag. It points straight to problems with risk management.
Like not cutting losses quickly enough.
Exactly. Or maybe not letting winners run. It's fundamental stuff for long-term success.
Right. Now this one's interesting about the market itself. Does it only take one trader somewhere in the world to negate the positive outcome of any particular trade?
The original audience mostly disagreed with this, which is good.
Yeah, it shows a decent understanding.
Because the market's massive, right?
Yeah.
The idea one person can just cancel out your edge, it's a misconception. Your edge, if it's real, plays out over many trades.
Not just one random trade
Mhm.
influenced by someone else.
Now, here's a big psychological hurdle, especially for newer traders. Would you only put on a trade if you were sure it was going to be a winner?
Huh. I bet a lot of people initially nod yes to that one. The desire for certainty.
It's perhaps the biggest mental block. Pros know there's no certainty on any single trade. It's all about probabilities.
Playing the odds over time, not needing a guarantee right now.
Exactly. Which leads right into, do you always define your risk before you enter a trade?
This feels like trading 101. Hopefully most listeners are saying yes.
It should be yes. It's absolutely non-negotiable for staying in the game.
Knowing your max loss before you click the button?
Yep. It protects your capital, keeps emotions from hijacking your decisions when things get choppy.
Okay, how about this? Do you sometimes blame the market for what went wrong?
The market is out to get me syndrome.
We've all felt that flicker, right?
Sure, market conditions matter, but consistently blaming the market means you're not taking responsibility for your choices, your execution. Your results are ultimately down to you.
Hard truth. Okay, this one's a bit counterintuitive. The more a trader learns about the nature of the markets, the easier it will be for them to execute their trades. But the video suggests not necessarily.
Yeah, it's a strange paradox. Sometimes the more you know, the more you see all the potential things that could go wrong.
Leading to overthinking, hesitation.
Exactly. Analysis paralysis.
Mm-hmm.
It can actually make it harder to act decisively on your signals, especially early on.
Interesting. And finally, to be a successful technical trader, do you have to determine what the market is going to do next?
We've kind of danced around this, but the answer is a clear no, right?
Yeah, seems pretty clear now.
Trying to predict the next tick, the next bar, it's a fool's errand. Success isn't about a crystal ball. It's about probabilities, patterns, and managing risk around those probabilities.
Okay, so these questions really set the stage perfectly for this key distinction Mark Douglas makes, which anyone can luck into a winning trade. One click, maybe you win. But being consistently profitable, that's a whole different ballgame. It needs different skills and, crucially, a different mindset.
It's the difference between, say, hitting a jackpot on a slot machine once.
And being a professional poker player who wins consistently over years. Different skill sets entirely.
And that difference leads into this idea of closing the profit gap.
Explain that.
Well, many traders have a strategy that, on paper, looks profitable. It has potential, but their actual bank account doesn't reflect that potential. There's a gap.
And it's usually not the strategy's fault.
Often, no. It's the trader's mindset, their execution, how they think about trading. That's what needs to change to close that gap.
And the #1 mental skill for closing that gap, according to Douglas.
Trading without fear.
That sounds bold. Trading without fear.
Yeah, it's the bedrock. But it's not about being reckless or careless. It comes from truly, deeply understanding probabilities.
Okay, so contrast that with just having one winning trade. What skills do you need for that?
Honestly, almost none. Just the ability to physically place the order, click the mouse.
Right. But consistency, that's built on something much deeper.
It's about what happens before, during, and after that click, over and over again. It demands moving from thinking trade by trade
Am I right or wrong now?
to thinking across a whole series of trades. Looking at the win-loss ratio, the expectancy over, say, the next 20, 50, 100 trades.
Thinking in probabilities.
Exactly. And understanding a key concept. Wins and losses within your edge are randomly distributed.
Meaning you can't know the outcome of the next trade.
Precisely. Even with a winning system, you could have 5 losses in a row, then 10 wins. You just don't know the sequence in advance.
It's like flipping a weighted coin. You know it favors heads long term, but the next flip could be tails.
Perfect analogy. And truly getting that is what frees professionals from needing to be sure about the next trade. They accept the uncertainty of any single outcome.
Okay, so that acceptance of uncertainty is key. And this links directly to our beliefs and expectations, right?
Absolutely. There's a direct line connecting what you believe about the market and how you feel when you're trading.
Because if you believe, you should know what happens next.
You're setting yourself up for constant emotional turmoil because the market doesn't offer that certainty.
So your expectation clashes with reality.
Exactly. And that gap between your expectation, certainty, and the market's reality, probability, fluctuation, that's where the negative emotions breed. Fear, anger, frustration.
So consistent results depend on aligning your expectations with how the market actually behaves.
Yeah.
Which is probabilistically.
You got it. Unrealistic expectations make you see normal market movements just ticks up and down as threatening.
And that triggers the big trading fears.
The 4 primary ones Douglas identifies.
Let's list them. Fear of being wrong.
Fear of losing money.
Fear of missing out FOMO.
And fear of leaving money on the table. Getting out too early.
I think we could all recognize those.
And the dangerous thing is, focusing on these fears often makes them happen. It's like a self-fulfilling prophecy.
How does that work?
Well, if you're terrified of being wrong, you might hesitate on good setups, or you might hold a loser way too long hoping it comes back just to avoid feeling wrong. So the fear causes the bad outcome.
Wow. And these fears are behind a lot of the common trading mistakes people make.
Definitely. Take the first one. Not defining your risk before you trade. Why would someone do that?
Maybe they think they know what's going to happen.
That's often part of it. A belief they're right. And also a subconscious fear of finding evidence against their belief, like setting a stop loss which acknowledges the possibility of being wrong.
Plus, maybe being wrong on a trade taps into older, deeper feelings about being wrong in life.
That's a powerful point. It can trigger a whole accumulation of past negative experiences.
Okay, error number 2. You define the risk, you
Yeah.
set the stop, but then you don't take the loss. You move the stop or cancel it.
Yeah, that shows you haven't truly accepted the risk emotionally. Intellectually, you know you should have a stop, but when the moment comes, the pain of taking the loss feels too great.
So you break your own rule.
Hoping for a miracle reversal, usually a costly hope.
Okay, what about hesitation? Getting in too late. Or the opposite, jumping the gun, getting in too early.
Hesitation often comes from doubt, needing more confirmation, that lingering desire for certainty again. You wait too long, miss the best entry.
And jumping the gun.
That can be driven by excitement, maybe after some wins, overconfidence. You see a pattern that isn't quite there yet because you're eager.
Impatience. Greed, maybe.
Could be. And then there's getting out of a winner too soon.
Fear taking over. Fear it'll reverse and wipe out the profit.
Classic fear-based decision. And the flip side, letting a winning trade turn into a loser.
That's got to be painful. Greed, believing it'll just go up forever.
Often, yes. Not wanting to accept the trend might be over, hoping for more until it reverses significantly,
And that last one, moving your stop closer to your entry, trying to reduce risk on the fly.
only to get nicked out right before it takes off in your direction. So frustrating.
What does that reveal?
Usually a lack of confidence in your original plan and your initially accepted risk. You're second-guessing yourself mid-trade, often to your detriment.
So these are the immediate errors.
Yeah.
But the video goes deeper into self-sabotaging beliefs. This sounds complex.
It is, and it's often unconscious.
Yeah.
Even with good skills, deep-seated beliefs about your own self-worth, about deserving success, can mess up your trading, especially as you start making more money.
The Ben Franklin accounting scale analogy was mentioned. Can you explain that?
Yeah, it's like we all have this internal balance sheet tallying up life experiences where we felt good about ourselves versus experiences where we felt bad, devalued, unworthy.
Okay.
And if that scale tips towards the negative overall, if deep down you don't feel you deserve success or wealth, internal forces can unconsciously cause you to make mistakes when your trading account grows.
Like an internal thermostat set too low?
Sort of, yeah, an unconscious resistance to exceeding what you feel you're worth.
And the idea of charting your equity curve to spot this.
It's fascinating. Looking for those sharp drawdowns that don't make sense based on market action alone. They might correlate with hitting new equity highs, suggesting sabotage.
And the example of the floor trader.
Mm-hmm.
His argument at home affected his trading.
Yes, a clear link. His emotional state from his personal life spilled over, causing uncharacteristic trading errors and losses. We're not as compartmentalized as we think.
That really brings it home. And the story about the Catholic trader.
Oh, that's a powerful one. His deep religious beliefs about money being somehow unclean or conflicting with spirituality were unconsciously causing him to basically give money away in his business decisions.
Until he consciously addressed that conflict.
Exactly. He had to reconcile those beliefs. Initially, he couldn't even put his rosary and his money in the same pocket. That's how deep it ran. Once he integrated it, his firm stabilized.
Wow. So this connects to the advice sometimes given after a big windfall profit to stop trading for a bit.
Yes, it's partly about preventing that self-sabotage impulse. Letting yourself get comfortable with the new level of success, reinforcing the belief that you deserve it before you risk giving it back unconsciously.
Okay, that makes sense. The video also discussed the shift from confidence to euphoria. That sounds dangerous.
Extremely dangerous. Euphoria is when you feel invincible. Risk seems to disappear entirely.
And it can happen after just one big win for some people.
Yeah, the threshold is different for everyone. A string of wins, or just one massive one, can tip someone over into feeling like they can't lose.
And the danger is?
You massively increase your position size, you ignore your rules, you feel certain you're right, you're setting yourself up for a huge fall.
And that fall can lead to mind freeze.
Yes, that terrifying state. The market moves hard against your oversized, euphoric position. You know you need to get out. You see the loss mounting, but you're just frozen, unable to act.
A total system crash, emotionally and mentally.
Pretty much. Shows how much emotions can override rational thought.
So to help navigate all this, Douglas outlines 3 developmental modes for traders. Let's start with the first one, Mechanical mode.
Right, the foundation. This is all about rules. Rigid criteria define your edge, when to enter, when to exit, how much to risk.
No guesswork.
Zero discretion in the moment. All decisions are made beforehand, based on the system's rules. The goal here is twofold. Test the system in the market and test yourself, can you follow the rules?
Identifying what works in the market and what works for your psychology.
Exactly. And this is where paper trading versus live trading comes in.
Paper trading helps understand the edge.
Yes, you see the system's potential win rate, average gain loss without risking cash, but it doesn't replicate the feel of having real money on the line.
That's where live trading comes in, even small.
Crucial. You need to experience the emotions of real trading to learn how to execute flawlessly under pressure. Starting really small, like one share, is key.
Why so small?
Position sizing is a huge factor in execution problems. Big size equals big emotion. Starting tiny lets you focus purely on following the rules perfectly, building that discipline without the fear of large losses.
Okay, build a habit first. Then, after mechanical, comes subjective mode.
Right. This builds on the mechanical foundation. It's more flexible. You start using all the knowledge you've gained about price action, patterns, market behavior.
So there's more discretion.
Yes, but it's informed discretion. You might adjust an entry slightly or manage a stop based on the current flow using your experience and pattern recognition.
But it's not driven by fear or greed.
That's the critical difference. It's based on analysis and experience within your overall risk framework, not just random impulses or emotional reactions. You're still anchored to your edge and risk management.
Okay, more nuance, more judgment, but still discipline.
Precisely.
And the final stage, intuitive mode. Sounds advanced.
It is. This is the zone. You're so attuned to the market flow, decisions feel almost instinctive. It draws on years of experience, patterns recognized unconsciously.
Not something you can just decide to do.
Definitely not. You can't force it. It emerges after you've mastered the mechanical and subjective skills. It's something you recognize when it happens.
But there's a danger here too, right? Confusing intuition with just hope.
Big danger. Without that solid foundation, what feels like a gut feeling might just be wishful thinking or justifying a bad trade. The real challenge at this stage is learning to trust genuine intuition while still having that rational risk overlay.
Training your rational brain to accept these deeper insights.
Exactly. It's a high level of integration.
Okay, so wrapping this deep dive up. It seems crystal clear that consistent trading success isn't just about charts or strategies. It's deeply tied to managing your mind.
Your beliefs, your expectations about the market, understanding probabilities instead of demanding certainty. That mental shift is fundamental.
And going through those developmental stages, mechanical, subjective, intuitive, shows you need to build that foundation first. Master the basics, master the execution before getting fancy.
Absolutely. You can't skip steps.
So hopefully this discussion has given you listening some food for thought about your own trading psychology.
Yeah, the idea is to spark some self-reflection. Where do you see yourself in these patterns, these challenges? What beliefs might be holding you back?
We really hope you'll mull over these concepts. Think about which fears, which errors might resonate with your own experience.
Because ultimately, mastering the market, well, it really starts with mastering yourself.